The financial system as we know it is about to undergo a transformation that most Americans are completely unprepared for. While mainstream media focuses on daily market fluctuations and political theater, something far more significant is happening behind closed doors at central banks and financial institutions worldwide. The signs are everywhere if you know where to look, and the implications for your retirement savings are staggering. Let me show you what's really happening right now. The Federal Reserve's balance sheet has expanded to levels that would have been unthinkable just a few years ago. We're talking about trillions of dollars created out of thin air, flooding into a system that's already stretched to its breaking point. But here's what they're not telling you on CNBC. This isn't sustainable, and the people running the system know it. Central banks across the globe are making moves that should alarm every person with money in traditional retirement accounts. They're not just buying gold anymore. They're hoarding it at a pace we haven't seen since the 1970s. The World Gold Council reported that central banks have been net buyers for over a decade straight, but the acceleration in recent years tells a different story. These aren't random purchases. These are strategic positioning moves by institutions that have access to information you and I will never see. Think about what that means for a moment. The very institutions that print money, that control interest rates, that supposedly have confidence in the fiat currency system, are stockpiling the one asset that has served as real money for 5,000 years. They're not buying more treasury bonds. They're not increasing their dollar reserves. They're converting paper into physical gold and storing it in vaults. The Chinese central bank has been particularly aggressive. For years, they reported modest gold purchases, adding maybe 10 or 20 tons here and there. Then suddenly the numbers exploded, hundreds of tons being added to reserves month after month. The People's Bank of China isn't doing this because they think gold is a nice shiny metal. They're doing it because they understand what's coming. They're preparing for a monetary system that looks fundamentally different from the one we have today. Russia took it even further. After facing sanctions, they didn't just complain about being cut off from the SWIFT system. They acted. They dumped U.S. treasuries and converted those holdings into gold. Massive quantities of gold. They built up reserves that now back a significant portion of their currency. This wasn't a panic move. This was a calculated strategy to insulate themselves from a dollar-dominated system they believe is on borrowed time. But it's not just adversarial nations. Poland, Hungary, Singapore, India, countries across the political and economic spectrum are loading up on gold. The Central Bank of Poland repatriated 100 tons of gold from the Bank of England, bringing it home to Warsaw. Why would they do that? Why would they go through the expense and logistics of physically moving that much gold unless they had serious concerns about the stability of the current system? Here's where it gets really interesting. The Bank for International Settlements, often called the Central Bank for Central Banks, changed the classification of gold in their Basel III regulations. They elevated gold to a Tier 1 asset, the same category as cash and government bonds. This is massive. It means that for regulatory purposes, the world's banking authorities now view gold as equivalent to the safest, most liquid assets in existence. They're essentially admitting that gold isn't just a commodity or a relic, it's money. Now let's talk about what this means for your IRA or 401k. Most Americans have their retirement savings locked into traditional accounts invested in stocks, bonds, and mutual funds. These are paper assets denominated in dollars, subject to the whims of monetary policy and market sentiment. When the system resets, and make no mistake, a reset is coming, those paper assets are going to be repriced in ways that could devastate retirement plans. Look at what happened in 1971 when Nixon closed the gold window. Overnight, the rules changed. The dollar was no longer backed by gold, and within a decade, inflation had ravaged the purchasing power of savings. People who thought they had secure retirements watched their nest egg shrink in real terms. The stock market went nowhere for years when adjusted for inflation. Gold, on the other hand, went from $35 an ounce to over $800 by 1980. That's not a coincidence. That's what happens when the monetary system undergoes a fundamental shift. We're seeing similar patterns today, but on a much larger scale. The amount of debt in the system is unprecedented. Government debt, corporate debt, consumer debt, all at levels that cannot be serviced under normal conditions. The only way to manage this debt is through inflation, through devaluing the currency, through financial repression that slowly erodes the value of your savings while making the debt burden more manageable for borrowers. The Federal Reserve is trapped. If they raise interest rates to fight inflation, they risk crashing the economy and triggering a debt crisis. If they keep rates low and continue printing money, they risk destroying confidence in the dollar itself. This is the definition of a no-win scenario, and it's why smart money is moving into hard assets that can't be printed or devalued by central bank policy. Quick aside here, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties or early withdrawal fees. Worth checking out if you want to understand your options for protecting wealth outside the traditional system. Now back to what's happening in the markets right now. The COMEX, the major exchange where gold futures are traded, has been showing some very unusual activity. The amount of physical gold available for delivery has been shrinking, while open interest in futures contracts has been growing. This is a classic setup for a squeeze. When you have more paper claims on gold than actual physical gold available to deliver, something has to give. We saw a preview of this a few years ago when several major institutions stood for delivery and the exchange had to scramble to find physical metal. Premiums on physical gold spiked. Delivery times extended from days to weeks. The paper price and the physical price started to diverge. That was just a warning shot. The real squeeze hasn't happened yet, but the conditions are being set up right now. Think about the mechanics of this for a moment. The gold market operates on a fractional reserve basis, just like the banking system. For every ounce of physical gold in a vault, there are multiple paper claims on that gold through futures contracts, ETFs, and allocated accounts. This works fine as long as everyone doesn't try to claim their gold at the same time. But what happens when confidence in the paper system breaks down? What happens when institutions and wealthy individuals decide they want physical metal in their possession rather than a promise on a screen? The London Bullion Market Association, the other major hub for gold trading, has similar dynamics at play. The amount of gold that changes hands on paper every day is vastly larger than the amount of physical gold that actually exists in London vaults. This is a system built on confidence and leverage. When that confidence cracks, the repricing will be swift and brutal for anyone caught on the wrong side. Here's something most people don't understand about gold. It's not really an investment in the traditional sense. It's insurance. It's a store of value that has survived every monetary system collapse in human history. When empires fall, when currencies fail, when governments default, gold remains. It doesn't pay dividends. It doesn't generate cash flow. But it preserves purchasing power across generations in a way that no paper asset ever has. Your grandfather could have bought a quality men's suit for an ounce of gold. Today, you can still buy a quality men's suit for an ounce of gold. The dollar price of gold has gone up. But that's not gold appreciating. That's the dollar depreciating. Gold is the constant. Fiat currency is the variable. Understanding this distinction is crucial to protecting wealth through monetary transitions. The wealthy have always understood this. Old money families, the kind that have preserved wealth across centuries, always hold significant gold positions, not because they're speculators or gold bugs, but because they've lived through enough monetary crises to know that paper promises eventually fail. Physical gold, held outside the banking system, is the ultimate form of financial insurance. But there's a problem for most Americans. Your IRA and 401k are locked into the traditional financial system. You can't just go buy gold bars and stick them in your retirement account. The IRS has specific rules about what you can hold and how you can hold it. This is by design. The government wants your retirement savings invested in assets they can track, tax, and if necessary, control. This is where the structure of a gold IRA becomes important. It's a legal way to hold physical precious metals in a tax-advantaged retirement account. The gold is held by a qualified custodian, stored in an approved depository. But it's your gold. It's not a paper claim. It's not an ETF share. It's actual physical metal with your name on it, held outside the banking system, but still within the retirement account structure that provides tax benefits. The process of setting this up is more straightforward than most people realize. You can do a direct rollover from an existing IRA or 401k without triggering taxes or penalties. The funds move from your current custodian to a precious metals custodian, and then you direct the purchase of physical gold or silver. The metal is delivered to a secure depository, and you receive regular statements showing exactly what you own and where it's stored. Now, I'm not saying you should put your entire retirement into gold. Diversification matters. But having zero exposure to physical precious metals in an environment like this is a massive risk that most people don't even realize they're taking. You're essentially betting that the current monetary system will remain stable, that central banks will successfully navigate the debt crisis, that inflation will stay under control, and that your paper assets will maintain their value. That's a lot of assumptions. Let's talk about what a bank reset actually means, because this term gets thrown around without much explanation. A reset doesn't necessarily mean the entire system collapses overnight. It could be more subtle. It could be a revaluation of currencies against gold. It could be the introduction of a new digital currency that replaces the current dollar. It could be a debt jubilee where obligations are restructured or written off. It could be capital controls that limit your ability to move money or access your accounts. History shows us that governments facing fiscal crises get creative. They freeze bank accounts. They impose wealth taxes. They force conversions of private retirement accounts into government bonds. They change the rules in the middle of the game because they have the power to do so. This isn't conspiracy theory. This is documented history from Argentina to Cyprus to Greece. When governments get desperate, private wealth becomes a target. The advantage of holding physical gold in a properly structured IRA is that it's outside the traditional banking system. It's not digits on a screen that can be frozen or seized with a keystroke. It's physical metal in a vault. If the banking system goes through a reset, if there are bail-ins or capital controls, your gold remains your gold. It's not part of a bank's balance sheet. It's not collateral for someone else's debt. It's yours. The timing of this matters more than most people realize. Once a crisis is obvious to everyone, it's too late to protect yourself. By the time bank runs start, by the time capital controls are announced, by the time the reset is publicly acknowledged, your options are gone. The time to position yourself is when things still seem relatively normal, when most people are complacent, when the warning signs are visible but not yet mainstream. We're in that window right now. The signs are there. Central banks are hoarding gold. Debt levels are unsustainable. Inflation is proving more persistent than authorities claimed. The banking system is showing stress. Geopolitical tensions are rising. The pieces are in place for a significant monetary shift, but most Americans are still operating as if the system will continue indefinitely in its current form. Think about the psychology of this for a moment. It's hard to take action on something that hasn't happened yet. It's hard to protect against a crisis that might seem abstract or distant. Human nature is to assume that tomorrow will look like today, that the system we've known our entire lives will continue. But monetary history tells a different story. Systems change, currencies fail, resets happen, and the people who prepare in advance are the ones who preserve their wealth. The question you need to ask yourself is this: what's the cost of being wrong? If you take steps to protect your retirement savings with physical gold and the system remains stable, what have you lost? You've diversified into an asset that has held value for thousands of years. You've added insurance to your portfolio. You've reduced your exposure to paper assets and monetary policy risk. That's not a bad outcome, even if the worst-case scenario doesn't materialize. But what if you don't take action and the reset happens? What if your IRA loses half its purchasing power to inflation? What if capital controls prevent you from accessing your accounts? What if the rules change and your retirement savings are forcibly converted into assets you didn't choose? The cost of being wrong in that direction is catastrophic. It's the difference between a comfortable retirement and financial devastation. This is why the wealthy are moving now. They're not waiting for confirmation. They're not waiting for the mainstream media to sound the alarm. They're looking at the same data we're discussing here and making decisions based on risk management rather than hope. They're converting paper wealth into hard assets. They're diversifying across jurisdictions. They're taking control of their financial future rather than leaving it in the hands of institutions that may not have their best interests at heart. The mechanics of the coming reset are already in motion. The International Monetary Fund has been discussing special drawing rights as a potential global reserve currency. Central banks are developing digital currencies that would give them unprecedented control over monetary transactions. The BRICS nations are working on alternative payment systems that bypass the dollar. These aren't fringe ideas. These are official policy discussions happening at the highest levels of global finance. When the reset comes, it will be presented as necessary, as inevitable, as the only solution to the crisis. There will be emergency measures. There will be assurances that it's for the greater good. There will be promises that your savings are safe. But the reality is that monetary resets always involve a transfer of wealth. Someone wins and someone loses. The question is which side of that transfer you want to be on. Physical gold has always been on the winning side of monetary transitions. It's the asset that gets revalued upward when currencies are devalued. It's the asset that maintains purchasing power when paper wealth evaporates. It's the asset that governments and central banks turn to when they need to restore confidence in a broken system. This pattern has repeated throughout history, and there's no reason to believe this time will be different. The opportunity to protect your retirement savings is still available, But that window won't stay open forever. As more people wake up to what's happening, as the crisis becomes more obvious, the ability to move wealth into physical gold will become more difficult. Premiums will rise. Availability will decrease. Regulatory changes could make transfers more complicated. The time to act is while the system still functions normally, while you still have options, while you can still make decisions on your own terms. Your retirement represents decades of work, of sacrifice, of planning for a future where you don't have to worry about money. Protecting that wealth from monetary system risk isn't paranoia. It's prudence. It's taking responsibility for your financial security rather than trusting institutions that have repeatedly proven they prioritize their own survival over your well-being. The bank reset is coming. The only question is whether you'll be prepared when it arrives.